Hi, everyone, and thank you for the opportunity to be with you today. And thanks to the City UK for hosting us. And let's talk about stress testing. So I've got quite a bit to say, so hang in there and get a cup of tea or something. And here we go. Last November, the Bank of England released a number of stress testing publications alongside the Financial Stability Report, and we published our 2024 desk-based stress test results, the results of our system-wide exploratory scenario, the SWES, as we call it, and we also published our new approach to stress testing the UK banking system. And that replaces the previous framework set out in 2015, and there's a significant step forward for us. So today, I want to outline the features of our new approach to stress testing the banks and set it in the context of the history of stress tests, as well as the other stress testing work that we do. And looking ahead, I will set out some of the aspirations that we've got for the future, including the need to join the dots between stress tests. I'll talk about the importance of stress testing in good times so that we are prepared for bad times, focusing on how the system as a whole supports households and businesses, being nimble and proportionate, and understanding behaviors. So you will see in the full version of this speech that there's quite a bit section on the history of a stress test, but I will spare you that just for now. And I will get to the point on that so that we get to the meat of our new approach. But I would still say that our approach to stress testing is rooted in the 2008 global financial crisis. And although there have been stresses since then, we should not forget the sheer impact of that crisis worldwide, the far-reaching consequences for households and businesses, and the considerable loss of economic growth that ensued in many economies, including here in the UK. I could say more about the role that the stress tests played during that crisis, but it was a key tool that we used to stop that crisis, to stem it, then to recapitalize the banks. And after that, stress tests have been key to strengthening the resilience of banks over time after that crisis. Then in 2015, we set out our approach generally to concurrent stress testing, which had two components. The first was a financial resilience stress test called the annual cyclical scenario for banks, which enabled us to assess banks' capital positions against a severe but plausible adverse scenario. And the scenarios in these exercises were counter-cyclical, and we set them so that they could be used to inform the setting of capital buffers. And our latest annual cyclical scenario results were published in 2023. The second component of our approach previously was the biennial exploratory scenarios, which is used to test risks not neatly linked to the financial cycle. For example, in 2021, we published the results of our tests of the risk from climate change. And gradually over time, stress tests have been useful not just to strengthen the resilience of banks, but also to compare them with each other and to spot risks on their balance sheets and explore new vulnerabilities. In a nutshell, quite simply, this stress testing is one of the most effective tools we have to demonstrate that major UK banks are safe and sound and can support households and businesses in bad times rather than make things worse. And we've seen the benefits of that in the recent challenging years in the wake of the pandemic, where, for example, banks could afford to give many households more time to repay their mortgages. So now let's move to developments since our previous approach. Now, alongside the gradual shift in what we learn from stress tests, the major macroeconomic and global shocks we have faced in recent years have led to change. They've required us to take a more adaptable and nimble approach, more informed by prevailing economic conditions. The COVID pandemic in particular had a big impact on our approach to stress testing. In the face of such a major shock hitting the UK economy, we had to adapt, reflecting that this was the first time we had to do a stress test during an actual stress since the global financial crisis. In 2020, we ran an internal desktop exercise that gave us rapid insights into the potential impacts of the pandemic. instead of the usual lengthier test with firm submissions. And doing this also allowed banks to divert resources to where they were most needed at the time. And we also ran a reverse stress test in 2020 to analyze the unfolding macroeconomic conditions and how bad things could get. Specifically, we tested how much worse the economic outcome would need to get to deplete banks' capital by as much as in the 2019 annual cyclical scenario. In 2021, we returned to a test involving firm submissions, but instead of the usual severe but plausible scenario, we tested to a more extreme adverse scenario to gain insights into the potential impact of a worsening of the pandemic. Through these episodes, we learned the value of being adaptable and being able to carry out different exercises using different scenarios and at varying levels of granularity and speed. These different types of tests are useful in telling us what we need to know at the time. And they provide a reliable assessment of a particular scenario we want to explore without undue burden on us or the firms, which we can trust to inform our decisions even in times of great uncertainty, rather than having to speculate or rely overly on subjective judgments. Most recently, in 2024, we ran a desk-based stress test. And by being desk-based, we were able to test the resilience of the banking system to two alternate scenarios, as opposed to just one scenario in the full tests involving firm submissions. And that test was based on our own modeling and judgments rather than requiring firm submissions. As well as testing the banking system, the Bank of England has also developed its wider toolkit for stress testing to cover different parts of the financial sector. Since 2015, we have been undertaking insurance stress tests, assessing the financial resilience of the general insurance sector, and since 2019, of the life insurance sector too. Those exercises give us valuable insights into the sector and its firms beyond what can be obtained from a firm's own solvency and risk management reports. They also help the PRA be better prepared to respond to potential shocks affecting the insurance sector. In 2025, indeed, the PRA stress testing framework for the life insurance sector will be enhanced by the intent to publish individual firm results. This will provide market participants with additional transparent and independent measures of an insurer's resilience and facilitate market education and self-discipline. And actually, the next life insurance stress test will be launched tomorrow, so keep an eye out for that. Since 2022, the bank has also conducted annual stress tests of UK central counterparties, CCPs, which are used to assess CCP's financial resilience and to promote transparency and confidence in the UK's clearing system. They include reverse stress testing, subjecting CCPs to different combinations of increasingly severe scenarios, number of defaulters, and costs of liquidating concentrated positions. CCP exercises have also included more agile desk-based stress testing, which can shed light on dark corners by exploring the impact of a wider range of scenarios. They consider the impact on liquidity needs of their clearing members as part of the tests, highlighting the system-wide analysis we do and need to do more of, which I will come on to later. And most recently, we undertook a new and first of its kind system-wide exercise, the SWES, which I alluded to before. And that SWES aimed to test the resilience of UK markets that are core to our country's economy by improving our understanding of the behaviors under stress conditions of banks and non-bank financial institutions and BFIs participating in those markets. And most importantly, how those behaviors might interact to amplify shocks and cascade from one market to another. We published the results of it at the end of 2024, and my colleague Lee Folger discussed these in a recent speech. We and the participants learned a lot from this exercise. It proved incredibly insightful. Now, let me turn to our updated approach to stress test the banks. So taking stock of all these changes since our original approach, we have reflected on the need to be adaptable, the shift in the context of our stress tests more broadly, and how we have been using them in practice. And our updated approach combines the predictability of regular stress testing for cyclical risks with the adaptability that Bank of England has used in recent years to explore different risks. It also benefited from engagement with participating banks, academics, and other stakeholders. It has three components. First, we will continue to run a financial resilience test of risks related to the financial cycle, involving submission from participating banks, but it will be every other year. It will be otherwise akin to the previous annual cyclical scenario test and will inform capital buffer setting. And going forward, we're calling this biennial exercise simply the bank capital stress test because that's what it is. Second, in the intervening years, we will supplement our assessment of the resilience of the banking system using stress testing when appropriate, but in a way that is much less burdensome for banks than our full bank capital stress test, for example, through desk-based exercises. Third, the Bank of England will continue to use exploratory exercises involving participation from banks akin to the bank exploratory scenario of the previous framework, but not strictly biennially. These tests will be a means of assessing other risks, including structural and emerging risks that are not closely linked to the financial cycle. Reducing the frequency of big firm submission tests represents a considerable efficiency gain without compromising our assessment of financial stability. It ensures the burden placed on participating banks is proportionate and supports the UK banking sector's competitiveness and growth. This change creates space for banks and for us to assess and address a wider set of risks facing the banking sector and will provide better insight in an evolving risk environment. It will also give participating banks greater capacity to invest in improvements in data, particularly crucial if they want to make the most of artificial intelligence, by the way, modeling and risk management. The new approach does not represent a reduction in the importance and value we placed on stress testing, quite the opposite, but it reflects an evolution of how we use it. A key reason why we are comfortable reducing the frequency of the full cyclical tests involving bank submissions is because banks are now much better capitalized. The last time we asked a participating bank to submit a capital plan to increase its level of capital as a result of a stress test was 2016. The tests have become increasingly about wider insights. So while we will still be keeping an eye on capital adequacy as a matter of routine, we no longer feel it needs to be done via a big set piece every year, especially given the cost of doing so and the benefits of exploring a wider range of risks. Now, while we value adaptability and the ability to use a range of tests to be more nimble, we also know the importance of predictability for participants to plan ahead. We intend for the bank capital stress test to be carried out every other year, and for other exercises involving firm submissions, as we have done in recent exploratory exercises, we'll engage with participants well in advance so they have time to prepare, and will endeavor to ensure submissions are proportionate. And when considering the timing of a future exercise, we will watch carefully the sequencing with other exercises. The new approach will also allow scope for synergies between the various bank stress tests, as well as between those and stress tests of other parts of the financial sector. For example, a desk-based stress test might allow initial exploration of a risk, which could subsequently be incorporated into the scenario for a bank capital stress test. Alternatively, a bank capital stress test may reveal a vulnerability that could become the focus of an exploratory stress test or targeted exercise. The new approach is more adaptable and risk responsive. It represents a pivot away from looking at point estimate capital positions to instead look at wider learnings about vulnerabilities and pockets of risk. It provides space to explore scenarios and the sources of potential future crises, but without losing the indispensable regular checks on financial resilience. Now, while we love stress tests, as you can tell, we need to remember that they can't give us all the answers. Credit Suisse was a perfect example of this. It is not a lack of capital that caused their failure, and indeed they passed many stress tests. Some answers have to come from elsewhere, although this is not the topic of today. Now, let's talk about joining the dots. We're excited about this updated approach. We feel it reflects the changes to the sector since inception of the framework and draws out what we have found useful in practice over the first decade of concurrent stress testing. I believe it gives us the flexibility we need without losing the rigor of the previous approach. Looking ahead, the next challenge we face is what I call joining the dots. We've been running relatively separate stress tests of different sectors, those of banks, insurers, CCPs, and system-wide, expanding our understanding with each successive exercise. In the future, I would like to use our approach to draw together even better our broader toolkits of exercises across sectors to enhance our understanding of system-wide dynamics. Risk-taking has shifted across the financial sector since the early days of stress tests, and we must use our toolkit to widen our understanding of the financial system and gain an increasingly comprehensive view of the risks affecting it. By joining the dots between exercises and findings, we can take an increasingly macro view of risks and vulnerabilities across the system. This will allow us to focus on testing the provision of vital services, and this requires a better understanding of the dynamics of the system, not just to focus on individual institutions, as Sarah Breeden recently spoke about. Lending and market making is increasingly shifting away from banks to non-bank financial institutions. The figures are striking. NBFIs now account for around half of total UK financial assets. Over the last 2 decades, they've accounted for the entirety of the cumulated increase in new UK corporate lending in the UK. And for example, NBFIs now account for 50% of the stock of corporate lending. However, importantly, banks remain exposed to these risks through the provision of repo, of leverage, and other forms of wholesale finance to non-banks. So banks remain very much involved, but in a different way. There has also been an increase recently in significant risk transfer transactions, which can help banks achieve capital relief on the risk transfer to investors through securitization. That trend provides further evidence of interconnectedness between banks and the rest of the financial sector and how risks can be distributed from banks to different corners of the system. The consequences of this need to be understood. We're also seeing risks transferred from banks to insurers or shared between them. For example, we need to continue to explore the links between banks' mortgage lending and insurance policies against flooding and the impact of climate change on both sectors. As highlighted in our latest FSR, we have been looking at the vulnerabilities emerging at the intersection of life insurance and private equity. Life insurance and reinsurance premiums are increasingly used as funding for lending activities in private credit via private equity-backed insurers and reinsurers. In this regard, and with respect to UK insurers' use of funding reinsurance, the 2025 life insurance stress test will provide useful insights into potential channels of disruptions. This highlights that some risks are very difficult to understand without taking a cross-sectoral view. These examples underscore the need to join the dots and take a broader picture in, where a sum of the parts approach may not give the right view. The idea is, of course, to continue our sectoral stress tests, but ensuring we are increasingly linking the findings from them and using one exercise to inform another. In practice, this could start with exploring scenario consistency and coherence between tests. We might consider where common scenarios could be used and the results of one stress test can inform another. One example of joining up our findings might be if market-focused exercises reveal behaviors under stress that are relevant for the way we test resilience within specific sectors of firms. Over time, we could seek a deeper understanding of interconnections, combined effects, and amplifications. I think we should aim for that. My aspirations is towards future stress tests that capture interlinkages and feedback loops between sectors. That could help us spot risks that are truly system-wide and not otherwise identifiable in isolation. This is clearly part of a journey, and we have all the answers immediately about how best to do this, but it is our direction of travel. We will learn by doing gradually and together with market participants themselves. This important work will allow us to of whether the financial sector as a whole is able to do its job of ultimate goal. The recent Suez has represented a big leap towards this goal. It proved to be an effective tool for understanding vulnerabilities that would not be apparent from sector-specific analysis alone. By including firms from a range of sectors and running it in 2 rounds, we could explore how the collective actions of firms in markets can amplify a shock, such as through forced sales, and understand system-level liquidity flows, such as how a shock at one fund causes them to redeem from another, or how initial margin is recycled in the system. We can better understand how the action of one firm can impact its investors or counterparties, and the system-level consequences, such as whether repo will be rolled and the consequences if not. We're committed to continuing to invest in our capabilities in this area to be able to carry out system-wide exercises in a more desk-based way, allowing us to monitor risks and understand how different shocks could play out, leading to more informed policymaking. And there will certainly be other system-wide dynamics or ecosystems that would benefit from future Suez-style exercises. As part of this increasingly holistic view of stress tests, we continue to consider their interaction with those we run on our own central bank balance sheets. The need overall for this more joined-up approach is greater than ever because the shape of risk to financial stability are evolving fast and with increasing interconnectedness. To stay on top of things, we need to consider the broader macro picture at the level of the whole financial sector. Otherwise, we would risk engaging in a whack-a-mole game that would be difficult to win. For example, increasing digitalization over recent years has changed the risk environment. Firms are more vulnerable, for example, to rapid liquidity outflows. Cyber risks are another consequence of this changing risk landscape, and the Bank of England will increasingly need to focus on such non-financial stresses to support our wider understanding. The bank has been undertaking stress tests of cyber resilience since 2019 and continues to do so. As we outlined in our last FSR, cyber attacks are one channel of increased risks that come with elevated geopolitical tensions. My FPC colleague Caroline Winkins will be speaking soon on this subject and the increasing importance of how we capture geopolitical risks. Now let's move to the value of stress testing for understanding systemic risks. And indeed, the need to join the dots is set against a broader context of a transition away from the last decade into a new era marked by a tighter monetary environment, digitalization, and climate change, against a broader backdrop of increased geopolitical tensions. As outlined in our most recent FSR, uncertainty around and risk to the central outlook have increased, and global risks associated with geopolitical tensions, global fragmentation, and pressures on sovereign debt levels remain material. The world is an unpredictable place. The collapse of Silicon Valley Bank in 2023 also served as a sharp reminder of how quickly risk can crystallize and how losses of confidence can impact a bank or cohort of banks. In this uncertainty lies a key strength of our approach to stress testing. The scenarios we test are not predictions of macroeconomic and financial conditions in the UK or abroad. Instead, they are hypothetical scenarios that we believe are useful to explore because they help spot the right risks and vulnerabilities in the system. They allow us, and just as importantly, firms themselves, to take steps to prepare for a range of plausible outcomes. And to emphasize, this is a great strength of stress testing in an uncertain world. It helps ensure the financial system is able to support the economy under a range of circumstances at a time when it's difficult to work out which ones are most likely. On the topic of helping firms prepare themselves for plausible scenarios, it is clear that a valuable aspect of our stress test is the disclosure of the results. That supports market discipline and enables the financial sector to be the first line of defense and take necessary action to manage risks. Publishing the results enables us to convey key messages about risks and vulnerabilities in a constructive manner. The more we do that in benign times, the more we enable the industry to fix the roof while the sun is shining, ahead of real stresses. Moreover, in a test involving firms, we can also provide private bilateral feedback on participants' modeling or judgments and explore where their approach departs from peers. This can help speak to the lack of perfect information for individual participants in the system, allowing us to play out the reactions of many actors. For example, the Suez highlighted mismatches in firms' expectations of how each other will act in a stress. And that led us to recommend that market participants consider taking steps to prepare for the risk that they cannot access additional repo during market stresses. By shining a light on how scenarios might unfold, our stress tests allow us and participants to mitigate risks preemptively. We have received a positive response on the usefulness of the information we shared from the Suez results, including for firms' own risk management. That's important because market participants need to be able to deal with severe but plausible scenarios themselves without expecting authorities to intervene and put taxpayer money at risk, as in 2008. Having said that, some scenarios are so severe and extreme that they can't reasonably be mitigated in advance. Indeed, if we try to eradicate all possible risks, this would lead to the stability of the graveyard and stunt growth. So we do not expect firms to have ex-ante resilience for each and every shock. We are not seeking, through stress testing, to remove all risk-taking from the system. And like other companies, financial institutions can and should be able to fail in an orderly way. What we as policymakers care about is the resilience of the system as a whole and its ability to continue supporting the real economy in severe but plausible scenarios without the need for intervention by public authorities. Even then, some shocks may be so large and the cost of the whole sector insuring itself against them would be so great that trying to do so would hamper the provision of vital financial services in normal times. So, as well as ensuring firms are prepared for risks, it is also important that we at the Bank of England have tools in our toolkit to step in when financial stability comes under threat. For example, in recognition of the increased importance of NBFIs, which I mentioned earlier, the bank has been working to develop tools to lend to them directly in times of severe dysfunction in core UK financial markets when financial stability is under threat, as Dave Ramsden spoke about in December. This is the latest addition to our toolbox. Not all resilience can be built in ex ante. Some resilience has to come from having the right tools to manage the stresses that threaten stability as they arise. Now let me conclude. We need to be selective and deliberate. Financial stability is indispensable for sustained economic growth, as the considerable loss of growth caused by the 2008 crisis starkly reminds us. The focus of our stress test has to be guided by the ultimate aim of financial stability, which is the provision by the financial sector as a whole of vital services to the real economy, such as lending, saving, insurance, payments, etc., in both good and bad times. Stress tests help us be focused and selective, and therefore enable us to be proportionate. That means future bank capital stress tests will continue to test banks' ability to keep lending through a stress, maintaining sufficient capital to absorb losses as they occur, whilst continuing to support UK households and businesses rather than closing shop to protect themselves. But our approach is also pivoting towards identifying vulnerabilities and pockets of risks, in step with a changing world. Directing resources where needed, being increasingly nimble, and ensuring the burden on firms is reasonable. And importantly, it allows us to continue joining the dots between various stress tests across the financial sector. By better linking insights and the design of our tests, we can gradually build a comprehensive, holistic view of the interaction between the financial sector and the economy. In doing so, we can respond to the changing risk environment and uncertainty of today's world. We can reflect the shift of sharing of risk between sectors, and we can do so in a way that is proportionate and selective and provides the stability needed to support growth. Finally, I encourage firms across the industry to adopt a similar mindset of joining the dots. The financial system is increasingly interconnected, and participants having open lines of communication with their financial counterparties to understand each other's reaction function in a stress is very helpful for the resilience of the system as a whole. It's part of being the first line of defense. Stress tests have a bright future. I'm proud of how far we've come and excited about how much more we can get out of them. Thank you.
Thank you very much indeed, Nat, for that. That was incredibly insightful, I think, for us as an audience and for institutions and practitioners in the market. Can I remind people that you can use the Q&A facility to put questions directly to Nat, and we can make this session institution. And I'm going to pick up as the sort of interactive, rather. I can pick up the process on that. Just to kick it off with a couple of questions that have come in. First, picking up on your point about stability of the graveyard and the need to avoid that. And what are your thoughts on how stress testing and the Bank of England more broadly can balance the need for regulation with the need for growth? The expression has been used, I think, we like gold standard regulation, but not gold-plated regulation. And do you think your new stress test arrangements land in the right place in that context?
That's definitely our aim, and that's definitely what we have in mind. And what we had in mind as we designed our new approach is to strike the right balance between pushing where it hurts and where it's meaningful for the economy versus being proportionate. So that's definitely our aim, and quite explicitly, actually, as part of this approach. But I would say a couple of things there. An extra, so hopefully you will see through the new approach that we are striving towards that, and there's a lighter burden of firms as a result of this new approach. That's very clear. But another thing that will help strike that balance is to focus on what financial stability is ultimately for.
Yeah.
Financial stability as a means to an end, not an end in itself. And that end is supporting the real economy, supporting households and businesses. So the more we adopt that mindset of vital services in both good and bad times, the more we can be selective and picking our battles, in a sense. So that I would make that point. The third point I would make on that is very much what I said, is that we can't possibly eliminate ex ante all risk. We shouldn't even try to do so. That would be a big mistake. And it's therefore important that we accept that some risk can only be managed and dealt with ex post, or as they arise, and striking that balance and having the right tools in our balance sheet to deal with instability as it arises is also a part of the answer. But if I may, on the point on deregulation, and I said this before, I will go back to the 2008 crisis. I remember from my personal experience as a regulator before the global financial crisis that there were big calls for deregulation. I remember that. And I remember how difficult they made our job. And then the next thing that happened was the global financial crisis. And that resulted in an enormous loss of growth for, globally and for the UK in particular. And the people who paid the price for it were households and businesses, way beyond the immediate people who lost their homes, but into much further into the future, and we are still living through the consequences of that. These things cast a very long shadow. So it's very important that we remember that lesson from history. We've heard that sort of mood music before, and we've seen where it leads. So let's learn those lessons from the past, and let's strike the right balance.
Okay, super. And yes, I mean, the damage done at that time to the reputation of the financial industry carried a very long shadow, didn't
Indeed.
it? Absolutely. So some points coming through, I think now, which are very supportive of the fact you're evolving this whole process to reflect sort of more modern and recent changes, for example, the NBFI piece, and the way you're approaching the increased complexity in the system and increased interconnectivity in the system. The question, I guess, coming out of that is, what are your expectations for banks and institutions as to how they adapt to the new regime? What would you like to see them do in reaction to these new approaches that you're putting in place?
So I think a good outcome of this. So we are we've learned several lessons that I tried to mention. One is the need to be agile and nimble, and also the value of enabling market participants to have the information they need, and which may be difficult for them to get otherwise, in order to manage their own risks. So what I'm hoping we're going to gradually evolve more and more towards is a world where we've created some space for banks and other market participants to invest in their own risk management capability. So I very much hope that they are going to do that. And the other thing is we will also adopt a mindset of feeding back as much as we possibly can about the information that we think would be helpful to help participants manage their risk. So that is also something that will be very useful for them to take. And the other thing I would hope that the industry does is very much take the spirit of this joining the dot approach and actually talk to their counterparties, not just in good times, but also during good times. Let's prepare for bad times and say, okay, well, if the situation becomes a bit tense, will I have access to this versus that funding, or do I need to prepare to look somewhere else? That is a really good conversation to have when the sun is still shining, in a sense. So that's the type of things I would hope will happen as part of that mindset.
Yes, it is the great cliche, isn't it, about fixing the roof while
Indeed.
the sun is out.
But it's very true. It's very true.
Absolutely.
And if I may, sorry, one more thing, if I may, the more that happens, everything we just discussed, the more market participants and the financial sector itself will be the first line of defense.
Yes.
And we'll let market discipline deal with most of the thing. And the more that happens, the less there is a need for regulation.
Yeah, absolutely right. So there's a point being made here, which is that there's a qualitative difference between existing known vulnerabilities. So, for example, again, the rapid expansion of NBFI credit and potential future risks, and perhaps those risks that stem from events or trends not yet identified.
Mm.
So I think the questioner here is very encouraged that the new framework can address both, which is tick in the box for you, I think, there. But could you say a little bit more about banks' approach to horizon scanning and stress testing against the unforeseen risks, the sort of Rumsfeldian unknown unknowns, if you like? What are we meant to do about that in the sector?
Well, exactly, and I think that's in part why we need to create more space to explore those dark corners. So we first need to be humble and acknowledge that, to the point of the question, we don't know yet all future risks. But I would say two things. First, use the space and the investment capability to actually explore those things. And the more we take a system-wide view of things, focusing not on individual institutions, but about what they do.
Yes.
What service they provide to the real economy, the more we can be almost invariant about how that service is provided, because the provision of financial services to the real economy is shifting. Who's doing it is shifting. So the more we focus on the core services, on the key nodes, almost from an operational perspective, the key nodes in the financial sector, the more we can have that holistic view, and in a way that then help us ask the right question. At the end of the day, it's all about asking. Once you know what question to ask, it's only about finding out the answer. But finding the right question to ask is difficult. So the more we focus on the provision of service to the real economy, the more likely we are, and market participants are, to be asking the right question and to push where it hurts.
Yes, it's a sort of positive reinforcing feedback, isn't it? With what is the purpose of doing all this?
It is,
and that should be the driver. Yeah.
But I very much agree with the spirit of the question, which is to look to the long term.
Yeah.
And that's part of one of our key roles as a central bank. When there's so much happening in the short term, there's always the temptation not to look to the long term, and that's part of our job, the central bank, to do that. But the more the market can do that too, and look through short-term shocks to long-term trends, the better. So I very much agree with the sentiment in question.
Yes, and you, as part of the sort of universe of possible shocks, geopolitics and cyber risk and some of these sort of newer items. Does climate risk fit into your analysis here?
Yes, definitely. So what I mentioned in the speech was that the way I think about things is that we are currently going through a period of transition away from a very unusual decade marked by very low interest rates, plenty of liquidity everywhere, which is a very exceptional period in many respects as a consequence of the global financial crisis. And actually, incidentally, it's a world for which there's an entire generation of people in the financial sector who've only known that world.
Yes.
And it's a big wake-up call to face the change in the music, in a sense. So the key things that are marking the transition we're going through at the moment are the tightening in the monetary environment, the return to normal. It is not an asteroid hitting us from outer space. It is just a return to normal.
Yeah.
The issue is that many people have not known a normal environment. There's that. The second aspect is digitalization, and we talked a bit about it earlier, and climate change, either physical or transitional, is the third feature of that shift in the environment and of what is going to mark the era we are entering now. And that transition happens against the backdrop of heightened geopolitical tensions.
Yeah. No, that's really interesting. I know the bank has done a lot of work on climate change, and Sarah Breeden led that for quite a long time.
Yes, she did.
Very effectively on the risk piece of that, and clearly affects not just the banks, but property and casualty insurance and all of those areas.
And if I may on that, so I mean, as I alluded to, we did an exploratory scenario, a stress test, a climate stress test a few years ago, which was very helpful. And we should, again, we try to be maximalist in how much we shared back to the industry, so that everyone could learn from it. But one of the key points that we need to bear in mind, we mentioned this in our financial stability report a month ago, is that although a number of risks related to climate, either physical climate risk or transitional climate, a number of these risks are long-term, but there's also a lot of short-term risk to that. And it would be very foolish to kid oneself that some of those things are not short-term. And we see it with the risk of floods. We see it with potential shocks to commodities markets because of climate transition. It pervades through many things that are today's issue, not tomorrow's issues. And it's very important that the industry thinks through those lenses of not just long-term, but very short-term risks and prepares for them.
Yeah, absolutely. And there's a questioner here who I think one could broadly frame this as a question which is about how does the bank respond to the data that comes through as a result of stress tests. And the specific example that's being given here is one that you mentioned, actually, which is a recently issued consultation to address leverage from NBFIs. And what are your thoughts about how you're going to take that forward? Have all the learnings from the bank's recent NBFI SWES been reflected, or is there still some way to go on that? What else is needed?
So that's a great question, and this is a very high priority for us for this year. As the question the participant mentioned, the FSB has published its consultation on the work in leverage in market-based finance. In my opinion, this is an excellent piece of work. It points to some of the key factors that have one way or another amplified most of the shocks we've experienced over the last 5 years. If you look at every single one of them, it's basically the issues, the amplifiers are being spotted and dealt with in a number of things that are in this financial stability board publication. So we've definitely contributed a lot to that. We're big fans of that work, and we think it has the potential to considerably de-risk market-based finance generally. So it's really important that people read it and respond to the consultation. The interesting thing is that, to the point of the question, the link to the SWES is very relevant, because if people went hadn't spotted that actually a number of those things are amplifiers that played out in recent shocks, in recent history, the Suez provides further illustration of that. So for example, one of the things we found, one of the great values of the Suez is the fact that we've got 2 rounds. So we don't assume people's behaviors, we ask them.
Yep.
And then we say, well, you think your counterparty is going to do X. Actually, they're not going to do X, they're going to do Y. So, you need to readjust. And one thing we found in terms of mismatches in assumption is the availability of repos in a shock, in a stress. And banks say, we're not giving more repo. While some of their clients were suspecting that they did. And the interesting thing we found is that actually a number of banks said, well, actually, we're more likely to extend repos if the relationship, the relationship with the clients is cleared. Now, obviously, there's a question in the FSB report about the merits of clearing in de-risking the amplifiers we have. So these things illustrates the type of in quite live term, the impact that those policy proposals can have, the benefits, the positive impact that those things can have.
Yeah.
That's just one of a number of examples. But it does point to the merit of exercise like the Suez to just show the facts. And I think there's going to be a great space generally to just illustrate the facts and share them with everyone.
Yeah. I mean, this point about NBFIs, clearly a very hot topic for people on this particular call. And there's sort of another level of granularity here, which refers to a Dear CRO letter last year about the risk and capability of banks to run stress tests on private equity. And the questioner says there's still quite a lot of joining of dots on the data to be done.
Indeed.
And when would you expect banks to be able to embed end-to-end stress tests focused on the PE sector? Have you set a deadline or an aspirational deadline?
So that's a good question. I may just take a slightly broader step on this topic. This is one very important piece of the work we did, and we also set out our views on private equity and the link between private equity and financial stability last year. So towards the middle of last year, and our perspective is that by and large, the large growth in private equity is a very positive thing for the UK economy, because it increases the source of potential funding to companies in the UK, to businesses in the UK, and increases competition away from banks. So that's a positive thing for the UK, but it needs to be done safely. And there's a few features of the ecosystem that cause concern, which we thought needed to be considered. One is the presence of what I called, I think at the time, leverage on leverage, and I did a speech on that, which is it's very difficult to work out how much inbuilt leverage there is through the entire food chain of relationship in that ecosystem. And the other one is transparency, or rather the opacity of how valuations are arrived at, and the value of the companies at the end. But that is an issue for banks. So there are 2 pieces of work that are happening at the moment, which are relevant to that. First, the PRA is to that question is doing work with banks to improve those risk management capabilities. But the other thing, sorry, I should mention, is that banks are finding that the total aggregate exposure to the entirety of the ecosystem, not just one fund or one portfolio, is very large. But what we have found is that this has been another instance where banks have struggled to add things up and to understand exactly how concentrated they were. This is not a new story.
No, not
with a bank. So that is the objective of the PRA work that is referenced in the question. So that work has been well underway. There's been good discussions between the PRA and the banks, and I'm expecting that this year we're going to review the results, the outcome of that work. So that's the sort of a timeline we're working on. The same thing for the other important piece of work that is happening, which is work by the Financial Conduct Authority, which is looking at the governance around valuations. So what we said is that those are 2 important pieces of work by microprudential and conduct regulators. We need to see the outcome of those things, and then we will take stock from a system-wide perspective about what they mean.
Yeah, I mean, there's a question here which is exactly to that point about microprudential and macroprudential, and again, it's a very practical question, I think, which is, when you've conducted the stress tests and you've got your set of results, what is the process for assessing that the industry is leveraging or embedding stress testing results into their own decision making on risk and opportunity? Do you mark their homework, as it were, at some point?
So this is something the PRA does. So the microprudential regulator, the supervisor of banks, does as part of the stress testing process, the full-blown, bank submission stress testing process. There's a dialogue between the supervisors, the risk specialists, and the banks submitting their own estimates. And on the back of that, there's feedback that is given to individual bank participants to say, well, this is how your methodology differs from what we have seen elsewhere, and giving that type of feedback. And I think it's very helpful. It is a good thing, and it is part of us giving information back to firms so that they can factor it in for their own risk management. So it's definitely part of the supervisory process. I mean, I speak as a former supervisor myself.
Yes.
That's not something we, the macroprudential authorities, do, but it's definitely something the PRA does.
Yeah. Well, I think, one more question really, and then we'll ask you to kind of wrap up the discussion in a couple of minutes. It's been fantastically useful, lots of calls coming through, and just in a practical sense, it is obviously hard work and resource intensive to do stress tests if you're an institution or a bank. To what extent do you, and therefore sequencing is very important, and how you time and ask for these things. To what extent do you think the way forward is quite considerably AI driven, given the number of data points you're looking
Absolutely. I think this is a really good point. And I alluded to AI in my speech for that.
Both as a risk and as an opportunity.
Well, yeah, as an opportunity, and it's really important that the financial sector, including banks, including insurers and others, really think hard about the opportunities from AI. But a big point to make, and it's very relevant for stress testing, is that a necessary condition to be able to make the most of AI is to have proper data.
Yes.
Otherwise, it's rubbish in, rubbish out.
Yep.
Sorry, excuse me.
No, it's spot on. Yeah.
Forget about stress testing. That is a really important thing to do. So it was already the case that proper data was vital for stress testing. Now, to your point, you put the AI lens on, it's even more vital, almost from a competitive perspective. So that is why creating this space for investment is so important, because there's another reason to do the data homework.
Yeah, I think everybody would agree with that, with the point about the quality of the data, almost before you get to how that data is processed and handled and extrapolated and so on. Look, I think this has been absolutely fascinating, and clearly there's a lot of very innovative and forward-looking work going on to improve the quality of how we look at stress, therefore the quality of how we regulate, and therefore the quality of what we're offering to our end customers, who, as you almost started off by saying, is the reason why we do this. So, Nat, I wondered if you wanted to just round off with, 3 or 4 sentences of concluding remarks. What should our participants here take away from the session this afternoon?
Yeah, so I think one of the key things to take away is that this evolution in our approach is a symptom of us wanting to be more nimble, in step with the changing world, whilst retaining the robustness that we obtained, and not losing any of that ground, but do things in a smarter and in a more agile way, so that we can keep up collectively with the fast evolving world. And back to your point about looking to the long term, a good way of achieving that is to gradually adopt this mindset wherever possible of thinking through what financial stability is for, and looking at the ability of the system as a whole, not just individual institutions, to support the economy, to support households and support businesses. And everything boils down to that at the end of the day.
Yeah. And of course, it is about keeping our sector in the UK competitive, not only safe, but also agile and able to grow in a very dynamic, fast-changing, competitive world.
That's right.
So look, hugely appreciated that you could come here and deliver this speech and then stay around to answer some questions and get into a bit of a dialogue about what all this is for and how it's going to evolve. It's one of the great strengths of the city and the UK that we have regulators that we can engage with and have these discussions with, and that are internationally respected for what they do. So we're very grateful for your time and for your thoughts this afternoon. So I think with that, we're about at the time when we need to close the call. So thank you very much again, Nat, for coming along and doing this here.
Thank you for having me. It's a pleasure to be with you. Thank you.